folks, Scott here, and this is the wrap for Wednesday, November 6th. So this action has been a little crazy. You see, we've had several dojis here. This is the S&P 500 futures. We've basically been opening and closing all four of the past 4 days have actually opened and closed in near proximity. We've also had the last 3 days have been unfilled gaps. Now today was an unfilled up gap. You see the white line there. So today's low was above yesterday's close, but you may not be able to tell it or remember, but the high from yesterday was just below its prior close. So technically that was an unfilled down gap, and then the day before that, same concept, unfilled up gap. Now that pattern has only happened 3 consecutive unfilled gaps defined as unfilled up gap, unfilled down gap, unfilled up gap, only happened 6 times in 11 years. So that's not really worth looking at. But what is worth looking at is fading gaps after an unfilled up gap that was preceded by an unfilled down gap, and importantly, we closed above the close from 3 days ago that had that unfilled down gap. So really reversed a really strong, apparently, or appearing to have the bulls fully in charge. Of course, you know when I say things like that, I may be a little intentionally setting you up. And there you go. Shorting an up gap, and it was also above the 200-day moving average. Shorting an up gap in this case has had incredibly strong numbers using an end-of-day stop. Now it's a small sample size. It's 50-50 in terms of which way we're likely to gap. Down gap looks neutral overall. Unfilled up gap looks surprisingly strong. To be honest or frank, I really thought that down gaps would look this good or better, and it'd be the shorting the up gaps that would be problematic. So we just ran this and discussed it ad nauseum in our trading room and looked at it several different ways, including without the 200-day moving average, and the data still favors shorting up gaps. So I'd call that a clear short bias going into tomorrow. A little food for thought. Always fun to stumble on something that's a little counterintuitive, even for me and people who've been trading a while. All right, let's look at what we had this morning. If you look at our worksheet, which is a summation of the 8 individual gap guides, at a glance you could have told or seen that probably weren't going to fade the gap, even though I think some of the indices did open inside the prior highs. Just a 50-50 kind of trade. But if you look at the unique patterns on the worksheet, we had an unfilled up gap, unfilled down gap, made it a little bit more of a neutral setup. So that was actually confirming the guides showing a little bit of risk. But after a false update, it's been a positive. After a doji day, it's been a positive. My comments after yesterday's 3-day wedge pattern I talked about in last night's video, that was positive for fading up gaps, even if the gap was large. So that was interesting. This is a little bit of a nuance, but very specific. That's why I wanted to show it. Fading medium to large gaps. Put the price that equals the definition here, greater than 40% of the 5-day ATR, went above the 10 and 200-day moving averages after closing within 1% of a 200-day high close, but not at a 200-day high close. That's important. 46% win rate, 1.0 profit factor. So I even ran it and looked at above and below. If you were opening above and below the 200-day high close, the data was almost identical. So this was just a 50-50 no edge trade. And overall gap guides were neutral to risky. There were some mostly positives for unique patterns. Often I'll trade this with a speculative trade, try to get a partial gap fill weight win. Just decided to take my cue from the range guides today, and that ended up, I'm going to say, probably being a good decision. It ended up being a good decision. It's the right decision for me. Actually, definitely a good decision. I couldn't remember what had happened on the stop. It would have stopped you out, buffaloed you to the tick if you used a 5-point stop. Now, I always trade the UH zone with a 6-point stop. That would have survived. But if you traded our guide straight up, which pretty much all of my other setups, I start off with what the guide showed, which today would have been 5 points. You would have been stopped to the tick before it rolled over and did about a half gap fill and then consolidated the rest of the day. So, interesting price action, especially when you consider this. It was a good call to avoid the gap. But look at the Russell sold off, filled the gap, and then some, consolidate near its lows. And then Nasdaq's filled the gap, consolidate too. So markets at odds one another, making it a little bit more difficult to trade. I made the right decision to not do any trades today. Nothing triggered per the 15-minute or first hour range guides that were high probability. So I left them alone. And gosh, I'm sorry, I can't remember from day to day. I'm pretty sure I didn't do any trades yesterday, and I'm not sure I did trades the day before. A very quiet week so far here. So patience is key, though. My mental, psychological, emotional, financial capital is all saved up and ready to go when the right opportunity presents. So maybe that'll be tomorrow, maybe it won't. We'll see. And there you go. That is the wrap for Wednesday, November 6th. Have a good one.